Was it hawkish? Was it dovish? Was it wait and see? What do you think?
I think he struck a hawkish tone, but the content wasn't quite as hawkish as the way that he said it. He made it clear that the Fed is ready to raise rates again if necessary, but he didn't say that a rate hike was forthcoming necessarily. So I think he's taking a risk management approach where he's saying we're more likely to raise rates than lower them, but he's setting the market up in case they do need to raise rates again.
And going into this speech, the futures market was already pricing in almost a 0.5% or a 50-50 chance that they raise again in November. Is that in your expectation?
I think
sorry.
we're likely
we have them hiking.
Go ahead, Adia.
Yes, so we have them hiking 25 basis points in November, and we have them cutting just 75 basis points next year, and markets move towards both of those forecasts. But I actually agree that the comments were fairly balanced. They had both hawkish and dovish elements to them, and so ultimately he presented a Rorschach test to investors, and that's exactly what you're seeing in market action today.
One of the areas that he talked about was the labor market. I want to play a little bit of what he said about the tightness of those dynamics and the impact that may have on further hikes. Take a listen.
So far, job openings have declined substantially without increasing unemployment, a highly welcome but historically unusual result that appears to reflect large excess demand for labor. In addition, there is evidence that inflation has become more responsive to labor market tightness than was the case in recent decades. These changing dynamics may or may not persist, and this uncertainty underscores the need for agile policymaking.
Gus, what does he mean by that the labor market has become more responsive to tightness than in recent decades?
What he's saying is that strong wage growth, a tight labor market, is pushing overall inflation higher. As the economy has become more services dependent, strong wages are more likely to show up in inflation, which is what we're seeing. And so therefore, the Fed may need to push back a little bit harder against that tight labor market in order to get inflation to that 2% objective.
Would that, Aditya, be part of an argument for this being a rather hawkish speech? If not so much today, maybe in retrospect, if they do have to lean harder against the labor market?
Right. I think it's a little bit nuanced, because if inflation is more responsive to a tight labor market, then hopefully that works the other way around as well. To me, essentially what he's saying is that we finally found the steep part of the Phillips curve after being on the very flat part of the Phillips curve for over a decade, and that cuts both ways. So hopefully when the labor market does ease up, and we're seeing some signs of that, inflation should continue to cool relatively fast. That would be the hope for the Fed.
Yeah, we also got the University of Michigan data this morning, consumer sentiment. I think it was down a little bit. Yeah, 69.5 in August. But notably, inflation expectations are still higher than they used to be. Aditya, 3.3%, let's call it, with a little bit of a rebound in gasoline prices lately. Is this a data point you think they'll be concerned about?
I think the one-year inflation expectations figure was always going to go up with, as you said, the rebound in gasoline prices. 3% on the 10-year is pretty much fine. It's, as you mentioned, a little bit towards the high end of the recent range, but we haven't really broken outside that range. And so for now, they're pretty comfortable with that.
All right. Gus, where do we go from here?
I think we see the Fed holding steady. I think you saw President Harker and President Collins yesterday saying that they didn't think further rate hikes would be necessary. I think we will see a slowing in the labor market. We're likely to get a mild recession starting in early 2024 that will bring inflation back down to 2%. So we see the Fed holding steady in the near term and then cutting sometime in the late winter, early spring next year.
So do you think, is the message you're getting from them that they don't know any, that's your forecast, but they don't sound to me like they're particularly wedded to any forecast, that they're just kind of waiting like the rest of us to see how the data come in, Gus? Would you say that's right?
Yes, and I think Chair Powell made that clear. He said, look, we've gotten 2 good months of news on inflation, but we aren't sure that that's going to last, and they're going to be looking at the inflation data. They're going to be looking at the labor market. They're going to be looking for those slowings that they're expecting, and if they don't see them, then they're perfectly willing to raise rates again if that's what it takes.
And before we go, Aditya, just can you put some context around these high numbers we're getting for the third quarter from the Atlanta Fed? And not so much to get into whether they're any better than anyone else, but how strong could third quarter GDP be? How different might it look by the fourth quarter, first quarter of next year?
Right, so we're tracking 2.7% for the third quarter. The Atlanta Fed, of course, is closer to 6%. There's different elements to these forecasts, but the point is that we started at 2%, and very quickly with the early wave of July data, we've gone to 2.7%.